Welcome to the Broken Pie Chart Podcast, episode 362. I'm your host, Derek Moore. With me is Shane Skinner. Mike Snyder will be back next week. I think the volume in gold and silver was more than he could bear, so he didn't show up today for the podcast. But that's okay, because we'll talk about it. All right, Shane, I pulled some numbers. There is a feature in Bloomberg that has turnover in dollars. So let me throw some numbers out at you. $41.57 billion of SLV, the silver ETF, was traded today. Put that into perspective. I mean, end of December, it was what, like 4.5 billion? And that was more than normal over the last couple of years. You look at gold. Gold today, what was it, $38 billion in gold traded? If you could see this chart, you would see it is a massive number. Gold and silver today. And we saw silver. I mean, both of these were parabolic. So it's not surprising. I guess that, the challenge is, it's parabolic. I don't know what it's going to do next week or Monday, but you knew at some point it was going to do this, Shane. This is just how things go when they go up straight to the stratosphere.
Yeah, I mean it's gravity sort of kicked in, if you will. But in what gravity was in this instance, I don't know if it was just people, that had bought earlier this week that ran into margin calls as the day progressed today, as we pulled back significantly. I don't know if it was profit taking. Who knows? At the end of the day, though, that's how this goes. I mean, obviously, this doesn't necessarily mean it's the top in metals either. That's the other thing. But to see this much volume, this much turnover in both gold, silver today, it's historical. I don't know if this will be a once in a lifetime thing for me seeing this in my career. Maybe it'll be another decade or two before we have a day this big. Maybe it'll happen next week. But, the sheer magnitude of what's taken place over the past month and the past, 2025, the past year in metals is nothing but it's historical.
If you look at the chart and you say, okay, when you have this much volume, I mean, yesterday was a massive move up. I know it came back a little bit today. It definitely opened down, stayed down. But the question becomes, when you have this much volume and the surge in price, would it actually get to a level and just stick? Meaning all the people who are the net buyers, were they just going to stay and no one was going to sell? I don't know. I think what happens here, and it's really typical, you had a lot of discussion. People hold maybe silver coins, gold coins, whatever, start to think, oh, maybe I should start selling these. And I'm not saying that push today, but it's now in the retail, when we say retail, individual investors, it's being talked about. And one of the things, Shane, that I noticed, even as gold has been running the last couple of years, it has been running in a silent forest, meaning, if the tree falls in the forest, who hears it? Nobody was really talking about gold. And then people started talking about it. And I know a lot in the audience might say, well, that's not true. And I agree. I mean, it has been talked about, but was it talked about in 23, 24, even 25? I mean, people looked at it and said, well, I don't think it can go up much more. It certainly did. So I think, I don't know what the price of gold is going to do, but it's not a secret anymore. Retail is thinking about it, and we're being asked by people, oh, is now a good time to buy gold? And I'm also hearing, should I sell my gold coins and my silver coins? How much of a haircut do you take, Shane, if you have like silver bars or you take it to a place? I don't know.
So I think that depends on where you go. I think some places will give it to you spot, but when you go to buy, they're going to mark it up. So it might be a place where you can sell it at spot value, but to buy it back, you're going to pay considerable amount more than whatever spot's going for. I'm sure there are other places that they'll do both ends, right? They might charge you a markdown when you go to sell, depending on how much you're trying to unload or market conditions. But it brings up an excellent point and something that I think is so overlooked, especially in the commodities market. It's the concept of paper, right, versus physical and spot, and how they're interconnected. And at the same time, just because you have one doesn't mean that it necessarily perfectly translates to the other.
All right. The fact that we're leading off the show talking about gold and silver
What are we
tells you.
doing? Yeah.
I mean, 2 years ago, everyone would have turned off. All right, let's talk a little bit about PPI because it feeds into producer price index. And I think when the number came out, I saw some comments. Oh, that's high. You and I chatted a little bit this morning. I'm looking through. This is from Bloomberg. Contributions to U.S. Producer Price Index, all commodities, year over year. So about 3.296% year over year. And I'm looking through this list. So remember, this is year over year. Rubber and plastics up 0.01%. I mean, that's kind of the low end. Let's see. Okay, there's some pretty esoteric ones in here. Let me get to some, like transportation equipment up 0.235% year over year. So then you look, you say, well, what was really up? Metals and metal products. Oh, up 0.982% year over year. But it wasn't, I mean, the first reaction I think was wrong on this. And there's this nuance of how PPI is calculated. And margins were up about 1.7% month over month. It was a 0.5% rise month over month for the month of December. But margins going higher sort of implies that wholesalers' margins are increasing. I will put everyone to sleep, Shane, if I actually go into detail of how this is calculated. But it's 3% year over year. I know I just mentioned 3.29. That's all commodities, but everything. It's 3%. In 2025 or 2024, it was 3.5%. So full year, 3.5. Now it's 3. Does it move to under 3? Maybe. So I don't think this was a big deal, Shane.
No. And I mean, we'll know more in 6 months if this continues to move higher and ramp up. Yeah, that wouldn't be great if we're living through the 70s 2.0, and I'm not saying we are, but if we see this reflation take place after we went through the bout that we experienced.
There's no evidence of that, though.
No, I'm not saying at all there is. Yeah, that's completely sort of just basing, hey, this is going to happen because it happened. Then it looks like a similar setup on a chart, if you will. But what I wanted to actually bring up, what really stands out to me when looking at this, I'm less looking at the times where it's sort of normal and sideways like it is right now and has been for the past about year and a half, maybe, if you will, and how things were kind of prior to 2020. When things are normal, nothing seems to be really metals. Typically, it looks like in normal times, at least as of late, past year or so, have made up a majority of the inflation in PPI, the increase, if you will, like you mentioned. But when things get really bad, look at the 2021, 2022 here. It's fuels and fuel-related products and power, right? There is metals in there. And then it looks like chemicals and allied products, and then processed foods and feeds. So when you see it across multiple, all at the same time, all at once, then yeah, I think that's when inflation can get really nasty. It's affecting all layers and levels of.
Well, you're burying the lead.
From raw material to end consumer, right? Of course.
You're burying the lead. April of 2024, all commodities, remember this, just the commodity portion of PPI, was up about 22.5% year over year. They are up 3.296% year over year.
Right. Right. I mean, the year over year, where we were a year ago to now versus what it was like, yeah, from what, 23 to 24, completely different.
Yeah. No evidence here of inflation yet. Yeah. I mean, maybe there will, maybe there won't. All right, let's
But
go
again, when
to,
you say that comes back to supply chains too, it comes back to all sorts of other
well, it comes
things.
back to everything. Yeah. I mean,
Yeah.
there's,
Yeah.
and PPI, for those in the audience, it's sort of the producer price index. So you're measuring what producers' prices are year over year, as opposed to final goods inflation, which is in CPI. So part of the idea is, well, if this is going up, it eventually flows through to the consumer prices. But all right, 2026 year-to-date asset class returns as of 127. So that was a couple days ago. Fine. This is from Ritholtz Wealth. And meet the new boss, same as the old boss from last, like emerging markets, up 10% year to date. It's probably off now, last couple days, because the dollar, I think, came up. And developed foreign up 7.5%, US small cap equity up 6.2%. And then you look at S&P, US large cap equity. Well, just US large cap equity, about up 2%. Bitcoin up 2%. Yeah. And so I look at this and yeah, international is still doing pretty well. I think a lot of that was because of the dollar. The dollar rallied today. Metals, specifically silver and gold, dropped down. But I don't know. I mean, this is really, if you think about last year and then already year to date, I don't know if we're switching regimes because these can switch in and out, where US large cap is not the dominant. But I mean, we went many years where US large cap just dominated everything. So far, it's not there. I think you got to watch the dollar, though.
Yeah, I think that's right. I mean, the dollar's been a big mover. I think we broke below the lowest level the past 4 years this week. Touched a new low over that time frame. Realistically, we could
Which is good for
go.
equities.
Yeah, yeah. I mean, putting it together. I mean, you've got historically large caps, especially tech, right, have enjoyed years, if not decades now, of premium valuations. I'm not saying they're overvalued right now. I'm just saying that they've just ran for so long, and it's almost like over the past year or two, um, the markets have woken up to the idea that like you don't just have to buy U.S. large cap, U.S. tech mag 7. Like there are opportunities elsewhere to invest your money. And so, Bitcoin, it's so funny seeing Bitcoin and large cap equity sit there. They're both positive, up 2%, which year to date, I mean, obviously that's again different from the time this was pulled versus today. But, you know, for the longest time, those have been preached as like those are the runners. Like Bitcoin's had some insane returns on an annual basis some years, both positive and negative. Large caps have moved significantly over the past 5 to 10 years, more than 10 or less than 10% in a lot of years on their open to close. So we'll see how it plays out, but I don't think this is bad or signaling anything negative to you. I think it's healthy.
No, it is healthy, and we continue to see different areas of the market. I'm just going to check year to date. If we use something like, let's see, what do we want to use? Like the S&P 500. Okay, we can use that. We can use a couple different asset classes. Let's see. So, oh, you know what? I did 2025, 2026. There we go. Keep forgetting it's next year. So MicroStrategies, I just had it up there, minus 4.74% total return year to date. SPY, the S&P 500 ETF, that's up 1.29. And I'll just curious, gold after today, what is GLD? If we use that, up 11.72. So,
You got to
no,
do
it's
silver.
healthy. Equal weight. That was the
You
other
got to
one.
do silver too. Come on, you got to equal weight in silver.
Equal weight's up more than the S&P 500.
Good.
So up 2.71. And then if you look at MAGS, which I use as sort of it's an ETF, the Mag 7 ETF, it's up, 1.22. So the overall market is up more than the Mag 7, and the equal weight is up more than double the Mag 7. So yeah, I mean it's broadening. It's sort of healthy. All right, I want to talk about earnings. Jeff Weniger, though, had posted this. I don't know what to do with this chart, but I thought it was cool, so I'll talk about it. And this was probably yesterday. So he says at 18.5, the silver to copper ratio just passed November 1979 levels. The high was January 1980 when they pulled the rug on the Hunt brothers. These two metals are sometimes considered substitutes in conductivity, for example. Up here at these levels, should they persist, you start to see industrial users switch from silver to copper on account of basic economics. Okay. I don't know what to do with this chart, but it's a cool chart.
No, that's incredible that they mentioned that because silver is a conductor. It's extremely it's much better at cooling itself than copper. So the fact that that's actually a thing that fascinates me. I was not aware of this. Just from the standpoint of think about building something, the cost of silver versus copper. Silver's a better equipped to cool itself versus copper, which can overheat more easily. And a lot of the components and things we're building today, this tech-driven world, that's very interesting to me. I'll have to look more into this.
All right, let's talk about the earnings that happened. So kind of a curious, I don't think earnings were bad by either Apple, Microsoft, Meta, who is it, Tesla. But the reaction was sort of interesting. Microsoft, what is Microsoft in a drawdown now from its all-time high?
From all-time high, MSFT, we closed today at 430.29. All-time high was 555.45. So
yeah, so let me do the annotation here on a chart. I'll tell you.
125.16 divided by 5. We go 22.5% roughly down from its all-time high.
Yeah, over 20. So Microsoft is in a bear market. If you say 20 greater than 20% is a bear
20,
market.
Right.
So that's in a bear market.
Yeah.
Tesla, if you look at Tesla's chart, I mean, they came out with earnings. We talked about their valuation was higher definitely than the other ones. But I mean, Tesla really didn't go that anywhere. And then you have Apple. Like Apple, I think their earnings report seemed like it was good. It seemed to beat on the top and the bottom line, and iPhone demand seemed okay.
13.5% on Tesla. Yeah, Apple did great. You're 13.5% on Tesla. Apple, you're looking at about 10% roughly, 9-10%. So yeah, it will. And I've said it before. I feel like I'm going in circles, but this market being so close to all-time highs with some of the biggest names that have led this market over the past few years being so off their all-time highs. I mean, we really have seen this market's breadth widen out over the past, what would you say, 3-4 months now?
Yeah, no, I think that's fair. You look at, so Apple's down about 9.3% from its all-time high. And, the S&P at the same time, I mean, we were at 7,000 intraday. Was that back on Wednesday? Like I'm just thinking, that was Wednesday, right?
It feels like forever ago with the moves that have been made this week. But Wednesday we hit all-time high in the S&P, 7,002.28 on SPX. That's 60.
And,
I mean, 63 points off the high. That's nothing. That's not even a percent, I don't think.
so intraday we hit 7,000. The high on the 27th, the close was 69.7860. We are Armageddon. We are minus 0.57% off the all-time high,
Right.
closing high on the S&P.
And you've got silver and gold making the moves they've made. You've got some of the biggest mag names, right? 10, 15, 20 plus percent off their all-time highs. And yeah, this market's just resilient, to say the least.
It all comes back to earnings, though. And I took a look at the earnings estimates. So as you get these releases, you start to get new earnings estimates come out. And analysts, again, have raised their forward 12-month guidance. So 302.75. I think most recently it was just a touch over 300. 22.85 roughly is the forward PE. It's actually come down. It's come down while earnings estimates have gone up. And that's an example of earnings going up, expectations going up anyway, price coming down. That's a multiple contraction. And you look out 1 and 2 years and 3 years. I mean, they've got double-digit growth every year. They have sales growth close to 7% every year. Last year is like 6%. So I mean, those are pretty good margins. Expectations. I mean, who knows what happens?
Right.
When we look at the companies that are reporting this week, so I almost wish that they just did it all on one day, like all the big ones. But we do have AMD Tuesday after the close, Palantir Monday after the close, Disney before the open. I don't know if Disney is considered a big stock anymore. I mean, or an impactful stock.
No. I mean, it really isn't what it was, though. Disney 20, 30 years ago versus now. Nobody even talks about it anymore. It's crazy.
Not as a stock, no.
Yeah.
Alphabet, Qualcomm after the close on Wednesday, Amazon after the close Thursday. I'm looking at some of the other ones
PayPal,
here.
AMD, Tuesday morning and Tuesday afternoon, respectively.
Like if I look at this, I think the name on here I'm most interested in hearing from is Google/Alphabet.
Oh, because, come on. You're not interested in CME or SIBO?
I mean, yeah. I mean, from a trading perspective, seeing volumes and all that stuff. But no, I mean, it's Alphabet, and it is.
Absolutely. Are they still the leading of all the mag names? Are they still the one that's like at their high? I think.
Well, I mean, Google's doing better on a relative basis.
I think than any other mag name.
It feels like part of that is because I mean, I don't know how they're going to monetize. Like if you search now on Google, it's right at the top. It gives you the AI answer.
Yeah. And it's great. It's huge. I think at some point, like we saw Walmart came out, right? So they're going to partner with OpenAI for AI shopping. I think that
really, like how are you going to do AI shopping? What is that going to do?
So that's the thing. Say someone wants to start a new diet, right? And they want like a personal trainer or a dietitian. They don't want to go spend the money on it. You get on ChatGPT and, you give it some information, you get it synced up. Next thing you know, it can meal prep for you for the next 2 weeks. You can make your grocery list on ChatGPT, keep it revolving. Eventually, that's going to be able to communicate things on Walmart's side. It'll know when to order your stuff. Is
that why it's trading at almost 42 times forward 12-month earnings?
Probably because they're going to eventually look. You've seen the smart fridges; they're not quite there yet. This is all ways down the road. But I think that's where this is headed. I think that your smart fridge is going to be able to tell your phone that, hey, these 6 items are missing, and then it's going to be able to tell Walmart, hey, we need these 6 items, and it's going to confirm with you. And the next thing you know, you can go pick it up or have it delivered, and you didn't have to hardly lift a finger or bat an eye. It just does it for you. I mean, that's really the type of stuff I think this is trying to head for.
So I'll ask you a question.
Please.
Walmart is 41 points, according to Bloomberg, 41.63 times forward estimates. And if I look at Nvidia, and then I'll get to my question of what I'm going to ask you here. If you look at Nvidia's forward 12-month analyst estimates, the forward PE, they're at 27. So you have Walmart at over 41 times forward earnings. You have Nvidia at 27 times. Neither of us know where these companies, where their price is going to go. This is a purely sort of fun thing to do.
Right.
Shane, is Nvidia undervalued? Is Walmart overvalued? Like, how is Nvidia have a 27 forward PE, but Walmart has a 41?
I don't know. I think Walmart's undervalued. I think that Nvidia is going to help. Like think about the supply chain, how it turns into a living thing once it's all synced up. Predicting demand store by store, pricing dynamically, cutting waste. You can keep stock or shelves stocked with near like Amazon level efficiency, but at Walmart margins. Okay. On top of that, you've got the consumer side. AI quietly removes friction, smarter searches. So, the Walmart app, again, it's all going to be in part because NVIDIA chips make something like this possible. But that Walmart app is going to be able to, you just simply say, hey, I need dinner for 4. I need it in under 2 hours.
I'm not buying how they make. Look, I have no idea what these stocks can do. Neither do you, right?
No. But I think that's
purely intellectual exercise. But yeah. I don't buy it. Like, I'm looking. How are their profit margins? Now I'm going to have to look it up. What their profit margins are. But
I want to see the same comparison of Walmart stock and Cisco back in the 2000s. I want to see a similar setup if we can find this data. I would like to see how they were trading relative to each other then. I know it's not the same thing, but I think it'd be
here. I'll tell you. I'm sure. Well, I shouldn't say I'm sure. I am confident that NVIDIA's, if you look at their sales projections, analyst estimates of sales, analyst estimates of earnings, and you do the net profit margin, my guess is that NVIDIA is going to have bigger profit margins then. But let's see. So their revenue is expected to be over the next forward 12 months. So, or let's just say fiscal year 2026, $712 billion. And their net income is what? Net income adjusted. So 21 into 271. What is that?
21 into 271.
No, I've got the wrong number. All right. They're going to get bored of all this. But I'm just saying, like, I don't buy it. Like, and this is what's great about the market, because even if something you say, well, that doesn't really make sense. Like, Walmart's a store, and all right, you're bought in on this AI story. You're going to use ChatGPT, and people are going to shop more at Walmart. But
it's not just that, though. It's the supply chain. It's all of it. But I see your point. I think you have a valid point too. And the best part is we could both be right or wrong. That's the beauty of the market, right? You could be right or wrong about.
Well, that's why you just buy the index and you hedge. Like, these are all in there, and you let the index figure it out. I mean, that's
good luck knowing when Walmart material, like if and when the stock's going to start showing signs of benefiting from those things we just listed. Like, good luck timing all of that, being able to predict that. You just can't. So you buy it.
All right.
As a whole.
We'll flip a coin there, and we'll let everybody know what we think. I want to talk about Nvidia or Google's options for next week. Let me do the February 6th.
Okay.
Which is next Friday.
These new expirations coming out.
Let's see. So we closed today at 338 and change. Let's look at, I want to see what the implied volatility is for let's use the at the money's 338. Okay. Let me use the
340,
337.50.
37 and a half.
All right, so 54% implied volatility, according to Bloomberg. And so, okay, if you just divide 55 divided by 15.875, the square root of 252, number of trading days, it's a
Same.
1 day expected volatility, 1 day expected move of 3.46. And we have 5 trading days. So I say the square root of 5. This is how this stuff is done here. Times, what did I say? 3.46?
3.46.
So it's about a 7.5% move implied, single standard deviation move between, now, Monday morning and Friday. And this will all change on Monday. It will change by the time we come up to earnings. But I mean, it's given, think about it this way. Apple didn't really move too much after earnings.
No.
Microsoft did. Meta did. Tesla didn't move that much, right?
Tesla had a down week.
Yeah.
Moved up after earnings, but down on the week.
Could move up or down. I'm just saying the move. Like, we don't know where it's going to
go. No. It's, It's been a wash this week. A little bit of everything.
So then we have earnings on Palantir. Let's take a look at the Palantir. I'll bet you they have a little higher volatility, but maybe not. So same thing. We'll look at the expiration February 6th and closed about 146.59. So let's see. Yeah, 92 implied volatility.
Wow. Palantir is definitely one that's fallen under a lot of scrutiny with the financials. Just like, are they going to truly grow into this multiple, or is this just hype around AI?
I don't think volatility is saying anything about that. Volatility, the higher the implied volatility, the more the options market is pricing expected moves. And so higher implied volatility means the option market thinks there's a higher likelihood up or down that it's going to move more than something that has a lower implied volatility. We're also a day before the earnings too. So as you get closer to the earnings date, that I expect Wednesday, because Google's after the close, I expect Wednesday Google's implied volatility will go higher.
29.36% off the all-time high on Palantir from prior earnings. The day after prior earnings, we were at 207.52. The stock's now at 146.59. So, absolutely, this thing.
Yeah, not all the big stocks are making all-time highs. Other people are taking over. So that one's in a bear market by the classical definition.
What about that SanDisk stock that you had told me about?
I still can't believe this.
Well, what about SanDisk? Come on.
Well, let's look at I don't know that they have earnings. They just had earnings, right? They just
had them. Yep, after the bell. So they reported fiscal quarter 2 2026 revenue about $3.03 billion, well above expectations and sharply year over year and sequentially. The earnings expectations, I believe EPS came in at 3.30 was expectations, and they hit 6.2. So almost double the expectation. And
it was up $36 today, and this is a stock.
On the year, we opened the year at about 244.35.
Yeah.
Wow.
So 107% implied volatility. So remember, we say Google, and this one doesn't even have earnings next week to be a driver. So it's much, the expectation is it will be much more volatile than Google and on a relative basis. That's pretty high. The other one is Micron. And Micron, especially for me, I was telling you when I was on a trading desk back in 95, 96, probably. Yeah, probably around 95. I remember trading options on Micron. and it was like the big stock. Like think about the biggest stocks, the ones that are really moving. I don't remember where it was market cap wise, but everyone was talking about it. And people talked about it in such a way that, oh, these prices are justified. If you look at a long-term chart of Micron, like around 95, maybe into 2000, it kind of crested. It took a long time to get back there. Let me just look at the 1 week options on Micron. And yeah, I mean, the implied volatility, Micron closed 414.88 today. If I look at the monies, probably like a 415, 71.5% volatility.
Ooh, post earnings, not even near earnings. Yeah, that's huge. And I mean, this is just, these moves are nuts. I mean, look, Micron year over year, 52 weeks, up 348.5%. Year to date, it's up about 31.5%. But from this time last year to now, it's up 348%. Let's see, SanDisk.
Look at a long-term chart of it. If I do a max chart,
SanDisk 1,500% up this time last year. 1,500%.
I tell you, I'll be completely honest with you. I'm not exactly sure what they're. I haven't looked at SanDisk in a very long time. It was, used to have the memory card you put in your camera or your phone. And Micron, by the way, June of 2000. So this is a quarterly chart. It was $88. It took probably 20 years plus to get back there. And now it's 414 or so. So some crazy moves there in the markets.
Yeah.
All right, so we did a webinar this week, and it was interesting. We covered some themes. One of the things we talked about was if you were trying to make the bear case and say what's going to go wrong, and I put one of the slides in. It's the dollar, and the dollar did go up today as gold and silver was going down. It's just something to watch because it goes to earnings. Lower dollar means multinationals get a lift from that low dollar because they report their earnings in dollars. So if they earn in foreign currency, you translate that, you convert it back on the revenue side and on the income side. So weak dollar helps. A strong dollar dampens those earnings from the multinationals. So that's something to take a look at. And I think I'll be watching that. The other thing, I continue to watch earnings. We already talked about earnings. And then volatility. The VIX today, I don't think it crested 18. It closed below 18. But we just talked about how some of these stocks have really, really high implied volatilities. Across the S&P on whole, I mean, it's not low anymore, but it's not super high, like given where we are. So I feel like that VIX is properly assessing where we are right now. I mean, I'll let you know Monday or Tuesday, but it seems okay.
Yeah.
Amazon's the other one, I guess. If we take a look at Amazon, I'm curious to see what their implied volatility is. That one is, if I look, where did that close today, Shane? That was 239 and change.
239.30. Yeah. This one's been quiet, given how big and relevant Amazon's been. And I mean, they come to my house at least 3 times a week. I'm pretty sure it's usually me ordering from them.
Their implied volatility is not quiet. I mean, 67.
67. I mean, no, it's not.
They got earnings next week, so
yeah. Well, look, I mean, wouldn't you say that it's almost become a standard to see on any names that are this big, anywhere from a 5 to 10% move being priced in going into earnings? I think that's fair.
Oh, no, it is. It is. And I think these companies still matter for earnings. Because remember, the S&P 500, you aggregate all of the earnings. So take the smallest member of the S&P, and their contributions to the earnings bucket isn't as much as Apple's, as Microsoft, Nvidia, Amazon, all the big ones. So these companies still really matter to drive the earnings bucket.
Absolutely.
I think Professor Schiller, he once did a paper or an article, it might have been an article in the Wall Street Journal in 2008, 2009, where he kind of made the argument that you should weight the earnings based upon the weighting of the companies. And I think he did that because in 2008, 2009, you had companies that were, I mean, their earnings were bad, really bad, but then they chose that time to write off different stuff because it didn't matter. You know, if you're a CEO of one of those companies back then, you just say, yeah, I mean, we're in the great financial crisis, whatever. This project didn't work, write it down, take the charge. So he made the argument you should weight those earnings too. I mean, never really picked up steam, but it was an interesting argument that he made.
Yeah, I mean, I think that you've got lots of points can be made on how you can observe the market or draw conclusions based on doing equal weight versus, accounting for the actual weight each one of these names makes up. I mean, would you say too that, as time has passed, the larger accumulation of index funds versus just buying single name stocks has allowed for, you can have weeks like this where Apple's sort of does nothing, Tesla's down on the week, Microsoft's down big, Meta's up big. And yet if you're sitting in an index fund this week, right, you're eating all of that, the good, the bad, and the ugly. And on the week you finished up overall in the S&P. If you own SPY this week, your position closed up.
I mean, it could have been down too, but your point is that,
yeah,
I mean, you just own all these. And I made that point during we did an institutional webcast for advisors mainly. And one of the points was you have more turnover on the membership, meaning the names that are in the S&P 500 index. They turn over quicker. And naturally with an index, you're buying more of the things that are going up and you're selling stuff that's going down. And it is a committee that chooses what goes in. It's not completely arbitrary. There are some guidelines. I believe, they have to be profitable. They have to be U.S. companies, certain size, but they've got to make choices. And sometimes a company that's exiting might be in a certain sector and they decide, well, we want something that's generally like that. If there's a merger and two companies merge, well, then that opens up a spot too. So, I mean, it's an underappreciated aspect of the index is how you have names that are coming in. Theoretically, their earnings should be stronger than the ones that they are replacing. So yeah. Stocks for the Long Run, by the way. That's a good book, Jeremy Siegel. I don't know when the last time he's updated that. I feel like the 6th edition is... Yeah, I think the 6th edition was his last one.
Stocks for the Long Run, 6th edition here. Jeremy.
Yep, I think that's the last one. It's a good book. And, I mean, if you haven't read it, it's a pretty good book, especially if you're in our line of work. All right, Shane, let's get to recommendations. What do you got for us this week?
Yeah, so I'm going to watch the new Frankenstein on Netflix with my wife. I'm a huge fan of the book by Mary Shelley, actually. I like that classic literature stuff. It's great. But I think Guillermo del Toro directed it. And so I'm a big fan of some of his stuff as well. So I will have a review of that when I come back next week.
So you got nothing. It's a pre-recommendation then.
It's a pre-recommendation, and I don't think anybody can probably go wrong seeing that.
It's on your watch list.
Yeah.
Okay.
We'll go with it.
I think so. I started watching season 2 of The Pit. It's a good show, and I debated because I don't like the fact that HBO Max or HBO, they don't just release all the episodes at once. So I waited a couple of weeks and then I watched a couple episodes, and now I'm disappointed because I got to wait again. And apparently you get a new episode every week until April. So come on, HBO, be better. Just give me all the episodes. Let me decide. I'm a grown up. I can figure that out.
Yeah, this waiting it's the worst part. This isn't early 2000s. I think we talked about Wasp that one time. I mean, that's that was crazy when you had to tell somebody at work or at school or wherever you were the next day, hey, please don't talk about this. You'd have to alienate yourself from conversation so you don't hear what happened because you missed the show. Just totally different world.
The other thing I got through was Friends and Neighbors with John Hamm on Apple TV Plus. Thankfully, I could watch every episode because that season had already been dropped completely, and I think they're coming up on season 2. But I thought it was good. I thought it was entertaining. So The Pit, I give a strong buy recommendation. It's on my conviction list. Friends and Neighbors, I think it's a buy. That's where I'm at with that. So, and then we'll find out about Frankenstein next week. So,
yeah,
like I might read War and Peace again. I might not. I'll let you know.
Hey,
come back with something you watch. Come on.
Listen. I said it before, and I'll say it again because I'm sure nobody watched it. But Ballad of a Small Player on Netflix, it's really good. Ballad of a Small Player. Colin Farrell, I believe, is the actor in it, but it's really good. If you like cards, if you like just something different.
All right, so we got a couple recommendations. That's it. We did it. Everyone, we'll talk to you next week. Thanks for listening. We'll see you, Shane.
See you.